All right, we are on chapter 6 of Intermediate Accounting 1, and we are on revenue recognition. So this may seem like a very straight, simple thing, but it's really not. In the accounting classroom, it usually is, but in the real world, there can be a lot of gray area. And this is where, like, there's been a lot of changes into revenue recognition because of the way some people or some businesses were recognizing revenue, and it was kind of leading like the users of the financial information, leading them to different conclusions. So it's a little bit, we have a process now in place to recognize revenue. Okay, so let's kind of talk. What is revenues? Revenues are inflows or other enhancements of assets of the entity or settlements of liabilities. That's if you have, that unearned revenue. It can be a settlement of liability or the combination of both. Okay, from delivering, producing goods, rendering services, other activities that constitute the entity's ongoing major or central operations. Okay. Measuring revenue is very, very important because that is the first thing on your first financial statement. Your first financial statement is the income statement and it is the top. How much of our revenue? How much is revenues? Okay. So it is very important not only to figure out how much, but also when do we recognize this revenue. Okay. So we have this five-step process, and they will actually, through this whole chapter, they will keep touching on this five steps as we go through the entire chapter. Okay. Identify contract, identify the performance obligations, because there may be more than one performance obligation, determine a transaction price, allocate the transaction price, and then recognize revenue when or as each performance obligation has been satisfied. Okay, so here we have a little bit more information on the exact same thing. Um, right here, where identify the performance obligation. I had just mentioned that if it's a single one, a lot of times it's pretty straightforward, but it's when they start adding multiple obligations and they start packaging things together in a contract. Okay, we're going to talk about this gaming system that's going along with a subscription to play the games. Okay. All right, so I'm skipping these concept checks. You can go back and look at them on your PowerPoint and read over them. I just hate to make the videos super, super long by touching on those. So, recognizing revenue at a single point in time. We know revenue has been earned by some key factors here. Okay. If the customer has control of the good or service, okay, an obligation to pay the seller has happened. Legal title to the asset, okay? Physical possession of the asset, and the customer has assumed all the risk and rewards. Think about if you bought a gallon of milk and you're walking out of Sam's and you're walking to your car and you drop that gallon of milk, that is your risk of loss at that point. Yeah, maybe you could go back in and Sam's might give you another gallon of milk just to be good, but it's really after that point, you are the one that has that risk and reward of the ownership. Okay. And it is accepted as an asset. Okay. So they go through this example. True Tech Industries sells a Tribox, a gaming console that allows users to play video games individually or multiplayer environments over the internet. The Tribox is only a gaming module and includes no other goods or services. So TrueTech sold 1,000 Triboxes to comp stores. Okay, they did that on December the 20th, 2026. Okay. And they said the price of each one was $240, promising payment within 30 days after the delivery. Revenue has not been earned right here on December the 20th. They have just ordered it. Okay. There's not even a journal entry that we're going to make right now. Okay. So revenue isn't recognized right now because we haven't delivered the product. Okay. So we come down here to January 1st and the product is delivered. Those 1,000 boxes, at $240 each, which gives us accounts receivable debit of 240,000 and will credit sales revenue. Just so we don't forget our accounting rules, remember, we're selling something here. We would need to take it out of inventory. That's not the point they're trying to drive home. But remember, you would make that extra entry to debit cost of goods sold and credit merchandise inventory if you were on perpetual inventory. Okay, so just don't forget about that because some of the problems in the chapter might throw in a cost of goods sold number, and you should know what to do with it at this point. Okay, so they didn't get cash. They got a promise to pay cash sometime in the future. And so on January 25th, TruTech pays or receives $240,000 from comp stores. So we increase cash, decrease the accounts receivable. The accounts receivable just holds it for us until we get the cash. Accounts receivable is an asset. A lot of students don't think it's an asset because we haven't gotten the cash yet. It is an asset. They owe us money. Okay. All right. So let's jump past these concept checks. Okay. So recognizing revenue over a period of time. So the customer consumes the benefit of the seller's work as it is performed. So it could be a cleaning service. Okay. The customer controls the asset as it is created, constructing a building, something like that. The seller is creating an asset with no alternative use to the seller, and the seller has the legal right to proceed to receive payment for progress to date. Okay. Example, an order of jets customized for the U.S. Air Force. Okay. Revenues recognized in proportion to the amount of the performance obligation to be satisfied. Okay. So here we have we're still following along with our TruTech. TruTech sells 1-year subscriptions to the TriNet multi-platform of internet-based games. They sell 1,000 subscriptions for $60 each on January 1st, 2027. We are not going to record revenue on January 1st. We are getting the cash on January 1st, 2027. That's all we're doing. We haven't earned the revenue yet because we haven't provided the service. Okay. Remember an example that I've always told you, maybe it's a magazine subscription, and as they send out that publication, that company is gradually earning part of the revenue. Okay. So at the end of each of the 12 months following the sale, TruTech will record the following entry to recognize the subscription revenue. Okay, so January 31st, they would make this entry. Okay, they're just dividing it by 12 because it was a 12-month, it was a 1-year contract. We're taking it out of the deferred revenue, putting it into the service revenue. Okay, we got all the cash back there on January 1st, but we have not performed the service. Okay, so we're going to make this entry 12 times. And by the end of the year, you can see deferred revenue has got nothing in it because we've already provided the service that we promised on January 1st. And then there's $60,000 in the service revenue account. Okay. All right. So if the performance obligation doesn't meet any of these 3 criteria for recognizing revenue over time, we will recognize revenue at the point in time when the performance obligation has been completely satisfied. This is usually at the end of the contract. The one we just did was pretty simple because we were able to easily identify that that was over a 12-month period, and we can gradually amortize it, not really amortize it, they're adjusting entries. Okay. All right. We will pick up on the next slide in the next video.